I just want to say I really appreciate the opportunity to deliver this presentation to the Charity Village audience. You guys at Charity Village provide a great service and support to the nonprofit and charity sector in Canada, and I'm thrilled to be working with you to provide educational opportunities to the people working in the sector. So as Marina mentioned, my name is Gordon Holley, and I'm the president and CEO of a small CPA firm called Humanity Financial Management. And as a CPA CA for almost 25 years now, I love helping individuals and organizations that are trying to make the world a better place. In my role at Humanity Financial, I see the stress and anxiety produced by finances and financial reporting for many nonprofit organizations, charity board members, and senior staff. So we built our company to provide consulting and financial oversight to small and mid-sized nonprofit organizations and charities to help them better manage their internal finances and financial budgeting and reporting. Ultimately, our company works to instill confidence and credibility in organizations by streamlining their internal financial management so that they can focus their energies on their programs. Now, we chose to work in the not-for-profit sector because we believe not only that it has the biggest opportunities for improvement, but also it has the added bonus of being filled with the people that we enjoy working with the most. And like many people on the call today, you know, life really is too short not to feel like you're making a meaningful contribution and working with people that you really enjoy. We love that we can leverage our financial expertise to make a meaningful contribution to people and organizations that are trying to make the world a better place, and we find inspiration from the individuals who are tirelessly working for their causes. Many people think that working with numbers is dry and boring, but I ultimately get to work with people, and I love it when I can make their lives a little easier and a little less stressful. And working with numbers allows me to do that, and I love it. We're set up to work remotely, so we literally have clients all across Canada. A typical client for us would have revenue between $1 million and $10 million typically. And we fit best with organizations who need kind of more than a bookkeeper, but aren't large enough to require a full-time professional accountant. So while we don't work with many smaller organizations, most of what we have learned is just as applicable to them as to their larger colleagues. When I'm not working at Humanity, I've had about 35 cumulative years of board experience, mostly as treasurer, and I'm currently on the board of 4 small to mid-sized nonprofits and charities. One of the boards that I'm on is Vantage Point in Vancouver. I facilitate most of their financial governance workshops for not-for-profit organizations and charities. And this year I'm also doing financial governance webinars for Charity Village and for the Canadian Charity Law Association. In addition to our training today, we also offer a 2 to 3 day financial management training program called the Certified Nonprofit Accounting Professional Program for bookkeepers and accountants, senior staff, and board members who want to better understand the financial end of running a charity or not-for-profit organization. So that's about it for me. So let's dig into our content. So today we're going to be talking about critical financial controls. And I've broken the agenda into 2 parts. In part 1, we're going to talk about why you should care about critical financial controls. We'll set the stage by giving you some context about why critical financial controls should be really important to you and your organizations. First, we're going to talk about the role of boards as stewards of our stakeholders' money. Then we're going to talk about the primary financial risks that most organizations face. And we'll also talk about what you could lose and how that could impact, or what we could lose and how that could impact our organizations. And we'll share some industry statistics about financial losses in the nonprofit sector. And finally, in part 1, we'll show you some examples of news stories showing organizations that have been hit by employee theft. In part 2 of our agenda, now that we know what we're trying to protect against, we'll talk about what we can do to protect ourselves. We'll talk about processes you can follow to identify and manage internal financial risks in your organization. And then we'll talk about the most important things you can do to protect your organizations. These include things like getting the right people with the right skills, creating robust budgeting and reporting systems, and creating and documenting financial policies and procedures. We only have about an hour, so we'll really have to deal with most of this at a fairly high level, but we'll try and give you some specific examples of things you can do to protect your organizations immediately. So part 1, why should you care? Well, first of all, as not-for-profit organizations and charities, we're generally provided with funding by our donors or members. They entrust us to safely steward those funds and to spend them effectively to achieve our visions and missions. After all, that's why they gave us the money. And you can see some common elements in each of these role descriptions on your screen that are typically applied to board members. We've got definitions for steward, fiduciary, trustee, and guardian. And basically, board members of not-for-profit organizations and charities are entrusted to govern the organization and its financial assets for the benefit of their stakeholders. including their members, their funders, their community, the Canadian public, the Canada Revenue Agency, and possibly many others. So being a board member is a highly trusted position with a lot of responsibility. And as board members, we need to take that role seriously. Being on a board can be a lot of fun, but there's also some serious work that needs to get done. So what are the financial and reputational risks we're trying to protect ourselves against? Well, first, employee theft, fraud, and embezzlement is rampant in the not-for-profit sector. Best estimates today are that we lose between 5 to 7% of all of our revenues every year, and that affects about 25% of all organizations every year. Many organizations simply run out of cash because they don't do the cash flow projections to identify problems before they happen. And one of the biggest financial risks to organizations that have employees is the CRA payroll reassessment. Many organizations hire people as independent contractors when the CRA would in fact consider them employees. And many organizations end up getting hit by penalties and interest that can be so large they can essentially put them out of business. Losing charitable status results in an almost immediate 100% tax to the organization on all of its assets. They need to be paid either to the CRA or to another charity. And losing nonprofit status can result in your organization becoming taxable and having to pay tax on its income every year. And sometimes assessments are retroactive for a few years. So this can really have an impact on a lot of organizations. There are also risks of inappropriate asset use. For example, directors using organization cars for personal travel, or ineffective asset use. And finally, many organizations experience significant reporting errors which lead to decisions being made based on inaccurate information. I worked with one organization a couple of years ago that had annual revenue of about $1 million. There was actually an error on their financial statements. The size of the error was about $750,000 because their bookkeeper didn't understand deferred revenue and deferred contributions and how those worked or how they were supposed to work on financial statements. So this led to some significant surprises for the directors when the errors were corrected. And it also resulted in year-end funder reporting being significantly different than the quarterly reports that they had previously received. And there'll also be other financial risks that will be specific to each organization. I'd encourage all of you to consider what the primary financial risks are for your organization. So reputation in the nonprofit sector really is everything. Protecting the reputation of the organization and its directors is arguably the most important role as directors. And here's a quote that speaks directly to the importance of that from a book called Governance is Leadership. It says, armed with a strong reputation, a nonprofit will be favorably positioned to access capital markets, recruit talented staff, attract capable trustees, and engender public support. Reputation may not be everything, but whatever occupies second place ranks far behind. So let's do everything we can to protect our reputations and our assets. So I just wanted to give you a brief sense of, there really are two areas of significant risk. The first is organizational risk, and the second is director personal risk. And not only can organizations end up on the front page news, which happens more frequently than you would think. I've got Google search set up to send me any articles or discussions about things that happen on the internet that affect charities and fraud, and it's surprising that I've actually built up a significant file now of stories where either people are stealing from the organizations and they end up, it can end up putting organizations out of business. It can also significantly impact or make it significantly more difficult to attract donors and funders and board members and staff. If people have confidence in an organization's financial reporting, they're much more likely to want to participate as board members, participate as funders, and even staff. So at the end of the day, financial reporting really is important if we want to achieve our missions. We have to build confidence and credibility in people that are reading our financial information. So, of course, everybody asks this question, is my organization at risk? I recently attended, I guess it was an Institute of Corporate Directors panel on financial statements and fraud. And the auditor there said, in his view, every organization has to take the view that occupational fraud is occurring to some level in their organization. He actually said every organization. It's really just a matter of degree. But they made the point that those organizations with appropriate and functioning financial internal controls have significantly less risk. So let's talk about the statistics. In December 2011, CGA Canada did a survey of the presence of occupational fraud in small to medium organizations. And these are all organizations across all sectors, not limited to the not-for-profit sector. And they found that about 26% of the surveyed small organizations reported to have experienced at least one significant incident of occupational fraud in the last 12 months. The number was actually 37% in BC. And we expect significantly higher experience rates in the nonprofit sector because there's a significant atmosphere of trust. With respect to cash, it's often difficult to verify certain revenue streams, often significantly weaker internal controls, often a lack of business and financial expertise, and of course reliance on voluntary boards. So for these reasons, we think that the numbers are probably in excess of 50% of organizations experience a significant instance of occupational fraud every year in the nonprofit and charity sector. The Association of Fraud Examiners in the US did a 2016 global fraud survey, and they concluded that the median losses to nonprofit organizations exceeded $100,000. That's the median losses in all frauds that took place in the nonprofit sector. And again, best estimates are that 5 to 7% of gross annual revenue in nonprofits is lost. Now in Canada, in 2014, we were about a $250 billion sector, and that's not including nonprofit organizations. That's just registered charities. And so if you take 5 to 7%, we're roughly looking at an annual loss of between 12 and $18 billion that could be used to feed the homeless, shelter the homeless and feed the hungry. So this is a really important topic. Now, just to give you a sense of what type of fraud is occurring in organizations, this is based on a study at Harvard University, found that 97% of theft and fraud takes place through asset misappropriation. So, and 95% of that was cash checks, credit cards, and expense reports. Fraudulent disbursements was about 75%, and fraudulent billing was about 50%. We had one case here in Vancouver where a bookkeeper was stealing from a golf club. They ended up creating their own company, so they incorporated a company and started sending invoices to the golf club. Well, the bookkeeper would approve the invoices, write the checks, sign the checks, and send them out to her company, and there weren't review processes in place to prevent her from doing that. And so she ended up making off with about $300,000 over, I think it was 3 or 4 years. Now, finally, she got caught, but it took a long time, and the golf club had a very difficult time coming back from that. It was difficult to get people to have confidence in working with the organization. And who's committing the occupational or employee fraud? Well, for the most part, and this is the tricky part, you know, we love to be a trusting sector, but for the most part, the people committing fraud and theft are very trusted people. On average, they've been with the organization for more than 10 years. They're between 30 and 50 years old, and they're often our most trusted people. You know, we often think to ourselves, well, hold on, that individual is never going to steal. But there's actually a theory by Donald Cressy, and he says there's 3 factors that must be present for people to steal. And actually, let me preface that. Other research suggests that 10% of people will look for opportunities to steal, 10% of people will never steal under any circumstances, and 80% will steal under the right circumstances. And the right circumstances, according to Donald Cressy, are pressure, well, financial pressure, opportunity, and rationalization. We can't do much about the financial pressure that people experience, you know, other than paying them a competitive fair market wage. or how they might rationalize the stealing, but we can do something about the opportunity. And by implementing effective internal controls, we can significantly reduce employee theft. And here's some examples of some that did get caught. Well, here's an article from the New York Times last year talking about trusted grown-ups who steal millions from youth sports. You know, who would have believed that this would ever happen frequently enough to be a thing? The article says now it's becoming common. So if your kids are in sports teams, keep an eye on the organization's finances. Here's an article that was done by NBC News on basically thefts in small charities. And there's 5 or 6 examples here that they went through, and these are fairly typical. One organization lost about $54,000. There's $54,000, $34,000, $60,000, $33,000, $78,000, and here's a whopper at an amateur hockey association, $934,000 that was lost by all of these organizations. And these organizations were a country food pantry, an elementary school, a Toys for Tots campaign, a swing band, a civic organization, a civic association, and a hockey league. So seriously, this can happen and does happen to every type of nonprofit organization and charity, small and large. No one's exempt. It's probably already happened at some stage in your organization, and you may just not be aware of it yet. I think they say, according to the Association of Fraud Examiners, it takes about 18 months to uncover a typical fraud. And we've heard sad stories from many of our clients before they started working with us about how they've been impacted by employee theft. It's just really not unusual. Okay, so now we've set the stage in terms of what the risks are and why critical financial controls are important. So what can we do to protect ourselves? And part 2 of this presentation will address just that. We'll provide some concrete examples of things you can start working on tomorrow that'll help theft-proof your organization. So, and this is a repeat of the slide right at the beginning, just to provide some context. So we'll talk about identifying and managing specific financial risks and some strategies to mitigate those risks, which really are the internal controls. Getting the right people, creating robust budgeting and reporting systems, and creating and documenting financial policies and procedures. So before we get into detail, I want to give you some context around risk management. And the best way to approach risk management is with a conscious and deliberate process to identify and evaluate the risks facing your organization, and in particular the financial risks. We just went through this process with one of the organizations I'm on the board of last year, and it was surprisingly straightforward. In a typical risk management process, we start by having a brainstorming session around all the possible financial risks that could impact our organization. And then we organize them and evaluate them. In our case, we came up with a risk register, which I'll show you an example of on the next slide. And using this matrix, we evaluated the risks to determine the likely impact to our organization. Then we took the biggest, most likely risks and developed some internal controls that would significantly reduce those risks. They were implemented, then we implemented those controls, and now we're in kind of maintenance mode. But we review the matrix every 6 months to make sure that we're preventing most of those big risks. And what a conscious process of risk management does is it helps you prioritize where you should be investing your time around internal controls. We'll talk about creating some basic internal controls later on, and those probably every organization should have. But if you want to protect yourself against the biggest risk, you got to know where to focus. So it's one thing for an organization to come to us and say, hey, we don't have any documented financial controls. Can you help us put some together? And our first response is, well, okay, so have you identified which financial controls are most important to you? And this is the process that most organizations need to go through in order to identify where we should be prioritizing our time to prevent the biggest and most likely risks. So here's an example of a risk register, fairly basic in Excel. It shows both the likelihood and the probable impact of each risk that we identified. And these really are just our collective gut senses. It wasn't any more scientific than that. And this evaluation process enables us to prioritize the risks and figure out which ones, again, that we should be addressing and which ones we should be allocating our available time and money to prevent. And this particular risk register also shows the mitigation strategies or internal controls that were developed and an evaluation of the remaining risk after those internal controls were implemented. And you can see, just looking at the column in the middle with the red, orange, yellow, and green, and the column on the far right-hand side, that there's a significant reduction in perceived risk for the organization after they implemented the internal controls. Now, when you do a risk management identification process, you'll usually organize your risks into these categories. So obviously, financial is one of them, but you also typically do, strategic risks, operational risks, people risks, regulatory risks, and governance risks. So completing a comprehensive risk management process is a highly recommended process for any organization. If you don't do this, it's hard to prioritize which internal controls will help you actually reduce your most significant risks. And it's very hard to get funding and resources to develop internal controls absent evidence that there are significant risks. I mean, even just getting your board to buy into to having staff spend time, or the board spend time on developing internal controls, is hard until you've sort of set the framework that, hey, you know what, we really do face some significant risk here. We want to protect both the organization and you directors, so help us dedicate some time to working on this. So I'd encourage you all to figure out how to do a little bit of this sometime over the next little while, and after you've done it, I think you'll realize the benefits and reduced anxiety you'll have around the risks in your organization. So with respect to financial internal control techniques, many people think of financial controls as just policies and procedures. There are really actually 8 standard types of internal control techniques around financial management. And depending on which types of risks you're trying to prevent, you would implement different techniques or combinations of techniques. So as you can see here, we've got supervision and review, management and board reporting, human resources, policies and procedures, analytical review, segregation of duties, which we'll talk about in a few minutes, audit trails, and reconciliations. So I said there were 3 things we could do to prevent theft and fraud in our organizations. 3 primary things. There's hundreds of things we could do, but really 3 primary things. These, I think, are the most important. And the first one is getting the right people with the right skills. So having the right people with the right financial skills is the single most effective internal control you can have. And this is true even in organizations with a working board and no staff. The board is responsible to ensure appropriate financial competency at all levels of the organization. Ultimately, it's responsible for both the quality and the relevance of financial reporting, of all the financial reporting that it receives, and to ensure that the relevance of that reporting is clearly understood by board members. The board is also responsible to ensure that there are appropriate financial internal controls in the organization. Getting the right people with the right skills is a big step in that direction. They will implement some of the techniques talked about earlier, so if you have the right people, the right things will happen. As a result, I think it's incumbent upon the board to ensure that the organization has appropriate people with appropriate financial skills and competencies throughout the organization, and in particular at the board level. All nonprofits and charities, regardless of size, should consider involving a professional accountant in their organization. And for clarity, we're not talking about your external auditor. In order to perform the audit, they're required to stay independent and can't get too closely involved in the day-to-day operations of the organization. Ideally, find a professional accountant who's willing to volunteer as your treasurer. And if that's not possible, or even if it is, consider hiring a part-time controller to assist with the budgeting and financial reporting and with reviewing the work of the bookkeeper for accuracy and completeness. Smaller organizations may find it easier to attract recently graduated professional accountants, while larger organizations may find it easier to attract accountants with more experience. But regardless of size, this is arguably the singular biggest thing you can do to protect the assets and reputations of your organization and your directors. You'll likely want to have 2 accountants on your board, in fact, one who's the treasurer now and one in training to take over when your current treasurer leaves. Also, as you're working on your succession planning for your board, you should consider selecting board members that have specific financial expertise and training. The quality of bookkeeping in most organizations is not what it should be. Most organizations would do well to upgrade their bookkeeper, either by replacing their existing bookkeeper or providing that bookkeeper with training and support. And finally, all organizations would do well to increase their financial competency training throughout their organizations, particularly at the board level. So best practices include considering engaging a volunteer professional accountant as your treasurer. Note that generally, treasurers should not be doing bookkeeping. If you've been successful at finding a skilled treasurer, if you have them doing bookkeeping, they probably won't last for long. And also, it doesn't allow appropriate oversight, which we'll talk about in a minute. But you want to prevent treasurer churn. You don't want to get your a professional CPA and they're acting as treasurer, then being told they've got to do the bookkeeping, and then they'll just get bored. And I mean, that's what they do during their day job. So they're not going to want to also be doing it typically when they're volunteering in the sector. Ideally, bookkeepers should have specific charity and nonprofit organization experience. I mean, just as an example, charities are required to file a different GST return than all other organizations. Many bookkeepers don't realize this, and they file the charity returns as if they were a small business or a not-for-profit organization, and ultimately it gets the charity in trouble. So it really helps if your if your bookkeeper has nonprofit and charity experience. And consider hiring a part-time controller, somebody who can review the work of the bookkeeper for accuracy and completeness, and somebody who can support the bookkeeper and train them to get better over time. If you're looking for a treasurer who's a professional accountant, here are some places you can look. First of all, look to your accounting firms and all of the accountants that you know. So if you've got an external auditor, go talk to your auditor, see if they can recommend, see if they've got somebody in their firm that's interested in becoming your treasurer. Talk to all of the accountants that you know. See if any of them either would be interested in joining your cause, volunteering some time as your treasurer, or if they know anybody that might be able to help. There's lots of accountants out there, and many of them are really interested in giving back and in volunteering, and would love to be able to help out as a treasurer. Charity Village has free postings for volunteer positions, volunteer board positions. CPA-BC, or this Chartered Professional Accountants BC, has a career site, and I think there are similar sites across Canada where you can post volunteer positions, I think for free, certainly in BC, and I suspect at most of the other provincial sites as well. And then Go Volunteer is a Vantage Point site. You must be a member of Vantage Point or another Go Volunteer member, but once you're a member, you can post volunteer positions. And again, trying to get a professional CPA as your treasurer. So I want to talk briefly about segregation of duties and appropriate review. And this is one of the internal control techniques that we identified earlier. And ideally, it's very simple. No one person should perform all of the functions within an accounting cycle and or have the ability to cover up an intentional or unintentional accounting error. So ideally, somebody in your organization, like either one of the board members or the executive director, is tasked with actually performing and carrying out transactions. So you might have ideally 2 signatures on a check, and they might be 2 board members, or they might be a board member and senior staff. So they're responsible for carrying out the transaction and initiating the transaction. And then in an ideal world, your bookkeeper would be responsible for recording the transaction. You might have an internal controller that would review the transaction that the bookkeeper posts for accuracy and completeness, and then you would have your treasurer sort of as a second level review to just make sure everything is all right, and then interpret and explain those things to the board. And most organizations in the nonprofit sector have room for improvement with respect to segregation of duties. In many cases, bookkeepers and treasurers are given unlimited access to the organization's bank accounts, for example. And they're effectively responsible for all aspects of cash management, authorization, review, and reporting. So they have custody of the assets, they can move cash around, they have signing authority at the bank, they're responsible for record keeping, recording the day-to-day transactions. Often they're also signing authorities, so they can sign checks, and they also do the reconciliations. So this allows them the opportunity to move cash around and hide it. If you segregate each of these functions with different people, they would all have to collude in order to take money and cover it up, which is much more difficult to do. So ideally, bookkeepers and treasurers would have, at most, read-only online access to bank accounts so that they can download transactions to bookkeeping software and download bank statements. And you should ideally, as I mentioned, have a part-time controller who reviews the work of the bookkeeper on an ongoing basis and checks the reconciliation that the bookkeeper prepares. And then finally, the treasurer would interpret the reports provided by the bookkeeper and controller for the board and act as a secondary review of all reports. Segregation of duties can go a long way toward protecting your assets and reputations. And good financial oversight is critical and should always involve at least 2 people. So as a result, if you really can't have your bookkeeper performing, you really can't have your treasurer performing your bookkeeping role because you really can't effectively review your own work. It's not an effective internal control. So you need to ensure that whoever's reviewing the work of the person doing your bookkeeping has appropriate financial skills in order to be an effective internal control. So that really covers getting the right people and making sure that they have the right financial skills. Now we're going to talk about creating robust financial budgeting and reporting systems. So effective financial budgeting and reporting is critical to board members, funders, donors, and other stakeholders. The key components of effective financial budgeting and reporting are preparing thoughtful budgets, ideally integrated with the organization's annual goals and operating plans. Preparing a cash flow projection in order to identify any expected cash shortages far enough in advance that the organization can adequately plan for them. Having a chart of accounts that allows the summarization of financial transactions in ways that are meaningful to the organization and that allow for good financial decisions. And you want adequate reporting by funder and contract and by program and project so that you can see what's going on at lower levels beyond just organization-wide. And budgets and actual results ideally should be tracked using the same framework if you can. And the board should also ensure that it's receiving adequate financial reporting so that it can monitor and control the organization's financial performance and protect its financial assets. So this involves software selection, systems design, financial skill levels, all of which are critical for effective budgeting and financial reporting systems. So some critical controls that you can implement around creating robust financial systems. Create and approve a budget before beginning of the year. Ideally, that should be a policy in every organization. Prepare a cash flow budget in addition to your revenue and expense budget. Use software that meets your needs. Ensure that the software you're using is set up properly. Make sure that your chart of accounts is well organized and summarizes information in a meaningful way. That you've got appropriate tax items set up, that you've got payroll items set up to fit your particular organization. This not only makes your bookkeeping and accounting efficient, it also makes it effective if the board members and fund members are getting, funders are getting the right information. Now, just a brief note on providing reporting to your board, and this is sort of what we would consider to be the minimum reporting that all boards should receive. First is a statement of financial position, and this is similar to a balance sheet in it's the same report, but it's called a balance sheet in the for-profit sector. In the non-for-profit sector, it's called a statement of financial position. And we'd encourage people to add notes. So if there are significant items on the balance sheet that are either changing significantly or the questions the board members might have, it's really useful to add notes to that statement of financial position. The second report we think they should be provided for virtually all organizations is an actual compared to budget, revenues and expenses, along with explanations of significant variances, both on a month-to-date basis, a quarter-to-date basis, and a year-to-date basis. So it's the actual compared to budget on the statement of operations that really allows organization to identify quickly where the most significant variances are and then spend time focusing on those variances. So rather than just giving your board an actual statement of operations which shows the revenues and expenses and have them go through and talk about the number of the gee, your supplies number seems high, how many paper clips are we buying? You can get them focused on the truly important issues if you really focus on the variances from budget. So that's probably the most critical report of all the reporting. And then a third piece that we like to see is a summary of CRA compliance. So when was your last tax reporting due? If you're a nonprofit organization, you've got a T2 to file and possibly a T1044. And if you're a charity, you've got a T3010 report due. So when was the last one due and when was it filed? Payroll. When was your last payroll due? When was it paid? When's the next one due? When's the next payroll remittance due? When was the last one paid? Are you up to date with your payroll remittances? When was your last GST or PS return due? And are you up to date with your installments or payments? WCB. All of these things around compliance is a really useful report because the directors at the end of the day are responsible both from a governance point of view and in the CRA's eyes. They can come after the directors personally for payroll and sales taxes. These reports are really useful from a director's point of view, and arguably boards should be getting them on a fairly frequent basis. So now we've talked about getting the right people with the right financial skills. We've talked about creating robust financial budgeting and reporting systems. Now we're going to talk about creating and documenting some basic financial policies. And so here's a list of 10 that I'm going to say are policies that virtually all organizations should have, regardless of how large they are. First of all, before I briefly describe each of these, I want to remind you that the purpose of these policies is to make sure your organization's finances are reviewed thoroughly and to support your board with its duty to provide oversight and to make sure that no one can steal or misuse your organization's finances. So here are the 10 policies that you want to consider creating, even for the smallest organizations. First of all, nobody in your organization should have electronic access to bank accounts unless it is specifically read-only. No individual, whether it's the board chair, the treasurer, the bookkeeper, or the controller, should be able to go online and initiate and create financial transactions. They shouldn't be able to do transfers between bank accounts. They shouldn't be able to do anything. That's a primary internal control that in many organizations is not happening today. So if your organization has one person that can go do transactions, get the board to approve a policy from now on and then go and change it with the bank. Second, no spending without an approved budget. That's fairly self-explanatory. It's really the only way that the board can provide effective oversight is if they approve a budget and nobody's given authority to spend in excess of budget. Otherwise, the board really can't do its job. Segregation of duties we talked about. Cash management and petty cash procedures. So petty cash is often used to cover small routine operational expenses such as, buying stamps, coffee, milk for coffee. And having petty cash on hand means you need safeguards in place to make sure that it's not, stolen or used inappropriately. So this will include physically securing the cash, such as in a locked drawer. And your policy may limit how much cash will be used and who can access it and what it can be used for and how it'll be replenished. So it's important that your policy is specific about keeping detailed records of your petty cash purchases. And if your organization frequently receives a lot of cash, such as from an event, ticket sales, you'll want to create a separate policy outlining how to handle that cash. And generally, the rule of thumb is whenever your organization is dealing with cash from events and things like that, that you should have 2 people involved in dealing with the cash. There should always be oversight when dealing with cash. Spending and signing authority. So it's important that you clearly spell out who's able to write checks and spend money on behalf of your organization. Ideally, you want to limit this to a few people, such as your leadership staff and 1 or 2 board members. You'll want to be specific about how much can be spent without first bringing it to the board for approval. What that number is really depends on the size of your organization and how much risk you're willing to accept and how often the board meets. So you may decide, for example, to allow your leadership staff person to use a prepaid credit card or a credit card and set a limit of $300 to cover small expenses or something like that. Again, it all depends on the size of your organization. But larger expenses might require a check be prepared and then signed by 2 different people. And as well, make sure that the person who inputs your financial records, such as your bookkeeper, does not have signing authority on your checkbook. 2 signatures should be required on all checks. Obviously, I think that's one that most organizations do fairly well. Although many organizations don't train their signing authorities about the processes they should be following before they sign a check. And so often the check signing is not an effective internal control. You really want people to take that seriously. You should have documented procedures that people are required to do. You know, check the date of the invoice, check the supplier, make sure the organization has received the goods or services, on and on and on. There are a number of things that each person signing a check should be required to follow before signing the check. Then that signature becomes an effective internal control. Transaction review and payment approval. You'll again want to separate the duties of reviewing your incoming invoices and bills and paying those bills. And one way of doing this is to create a check request form, which details who the invoice is from, its purpose, and the amount. This could be prepared by the bookkeeper, and then your treasurer or leadership staff person will review the request, checking to see that the paperwork's complete and that the invoice is attached before finally authorizing the request. And then finally, a check would be prepared and signed by 2 of your signing authorities. Travel and expense reimbursement, again, one of the big areas of internal control, failures or non-existence. And so you should have a policy, and it's very useful if your board, staff, and volunteers pay for any program costs up front and then get reimbursed by the organization later. It can help you outline what receipts and documents need to be submitted, who needs to review and approve them, and when reimbursements can be expected. There should be a policy about what kinds of payments can be made to directors, and these actually may be in your bylaws. There's typically 3 things that are 3 types of payments that can be made to directors. First, payments to directors in their role as directors. Second, payments to directors in other roles, i.e. a lawyer or accountant or something else, providing additional services. And then third would be reimbursing the directors for out-of-pocket expenses they paid for the organization. And interestingly, whether or not your organization can make payments to directors is typically determined by the, first of all, the incorporation legislation that your organization was incorporated under. So it's often a provincial or national legislation issue. It may or may not allow for certain types of payments to be made to directors. Also, your bylaws may limit or prevent certain types of payments to your directors. And if they're not in either of those, then you'll want to make sure that you've got some policies, some board-approved policies about what types of payments should be able to be made to directors. I would argue strongly that, again, one of the biggest risks, I think, to a lot of nonprofit organizations and charities is around hiring staff and contractors. If you hire, I know many organizations that hire everybody as independent contractors just because it's easy and then they don't have to make remittances to the CRA. And if those organizations get audited, they're under significant risk where they may have to pay up for the last 3 or 4 years all of the income tax deductions, CPP contributions, and EI contributions that they should have made with respect to those people. And that can be a significant cash flow hit to organizations. And many executive directors may not be aware of the specific tax rules around hiring staff and contractors. I've seen executive directors hired as independent contractors, and that's very unlikely that the CRA would accept that filing position if the organization was ever audited. So really key to make sure that you're on side with the CRA from a hiring perspective, and you should have a policy around that. And then finally, with respect to regulatory compliance, you really should have a policy about who's responsible to do what, who's responsible to file your returns. All the board members should be aware about which returns are required to be filed for your organization. It's really about roles and responsibilities and who's going to make sure that your organization's going to stay in compliance with the CRA. So those are in my view, 10 policies that are really critical for most organizations. If you had these 10, it would be a great start. So this gives you kind of an idea of where you can start. Take a look at the board-approved policies that you have now in your organization and make sure that you've got policies that cover each of these areas. And if you don't, there's something for you to work on. We've developed, for the benefit of, the sector really, a checklist for basic financial internal controls for small to medium-sized nonprofit organizations and charities. And it's available on our website, which you can see there. And here's a list of the sort of topics that are covered. You know, hiring the right employees, employee versus independent contractor, payments to volunteers, revenue, donation, cash receipts, and collections. So I'm not going to read it all, but you can see that there are a significant number of policies and internal controls that we've outlined that we think are at least a good starting point for organizations. So once you've sort of got the 10 we talked about earlier, go take a look at this document and see if there's others that are really important for your organization. So just to summarize, you know, why should we care? We talked about directors fulfilling their fiduciary responsibilities, stewarding the assets on behalf of the organization and stakeholders, making sure that they achieve organizational mission and vision, which is hard to do if somebody's stolen big amounts from your organization, protecting the assets and reputation of the organization, protecting the assets and reputations of directors, allowing the organization to attract and retain better funders, board members, and staff, reducing the risk of loss, reducing the risk of inappropriate or ineffective asset use, meeting the expectations of external monitoring agents like the CRA, and at the end of the day, if we all implemented effective financial internal controls, we could literally have another $12 to $18 billion in additional funding to spend as a sector, which would go a long way toward helping many of us achieve our missions. And summary, again, what can we do to protect ourselves? Get the right people with the right skills. Try and get a professional CPA as your treasurer would be a great start. Create robust budgeting and reporting systems, and create at least some basic financial policies in your organization that, you know, prevent some of the biggest risks. So just before wrapping up and opening up to questions, I'll note that I've provided some resources. Here's some on risk management. Grant Thornton's got a great article called Risky Business, which kind of gives you an overview of the risk management process. Carter's has a legal risk management checklist for nonprofit organizations. And CPA Canada has a 20 questions series. And one of the ones they have is 20 questions for nonprofit board directors should ask about overseeing the management of risk. These are all great resources, highly recommended reading. With respect to internal controls, if you're interested, if you're a larger organization, COSO, I can't remember what that stands for, but it's an organization that's done a huge amount of work around internal controls, primarily for larger organizations. And for smaller organizations, there's the checklist that I referred to earlier, the internal control checklist, and also there's a Board Source has a nonprofit policy sampler. I think they charge about, I don't know, I'm going to say it's under $100, but they have a number of policy templates that you can use. I think they provide them in Word, and you can customize them for your organization, so a good starting point. And then First Reference has a significantly more comprehensive list of sample policies that you can start with. And the difficulty, by the way, isn't getting these sample policies. The difficulty is actually taking the time and customizing them for your organization, because in order to be effective, the internal controls really have to be relevant for the size of your organization, the type of work that you do, and the type of financial risks that are specific to your organization. Taking policies from other organizations often just completely miss the mark and become completely irrelevant. So, but these are good starting points with Board Source and First Reference if you want to get some template policies that you can customize specifically for your organization. So, thank you, Marina, for allowing me the opportunity to present today, and thank you to everyone who participated. Financial internal controls are not the most exciting topic in the world, but it's a topic that's so incredibly important to our sector. So I'm thrilled to see so many people participating today and learning more about what they can do to improve their financial internal controls. If you don't have appropriate and functioning internal controls in place, it's likely only a matter of time before your organization gets hit. So I hope everyone who participated today is leaving with at least 1 or 2 ideas about steps they can take to improve their internal financial controls. I provided my contact information here, so feel free to contact me after the presentation if you have any further questions or want clarification of any of the topics we talked about today. And with that, I'll turn it back to Marina.
Wonderful. Thanks, Gordon. That was an amazing presentation. Lots of really good information there, and we've had tons of questions come up. So we're going to just dive right in. There's been a number of questions on your policy point number 1 about electronic banking, as I'm sure you probably are expecting. So first of all, can you maybe just talk a little bit about how electronic banking is more risky? And then secondly, you know, how that can be managed in a world that is sort of increasingly being pushed to be online. So for instance, we have PayPal, you know, that small organizations might be using, or we may have bill payments that are you know, required to be done online. Could you maybe talk about that a little bit?
Yeah, you know, it's a real challenge, Marina. Historically, before we had all the online payment stuff, it was relatively straightforward because, you know, in most organizations there was a policy that required, you know, the only way to access cash was either to have petty cash on site, which was generally small amounts, or to write checks. And if you were writing checks, it was relatively easy to have, you know, require 2 signatures and make sure that you had 2 responsible people signing the checks, and, you know, they'd go through the process. So it was fairly easy to have internal controls before the, you know, the internet and online banking and online payment systems. The difficulty now is that if you give your bookkeeper the ability to make electronic payments, or your treasurer or your board chair, for example, if that person is ever in a position where they're feeling financial pressure, you know, either, you know, the medical bills start to pile up, or, you know, for whatever reason, you open yourself up to a real risk of loss. And so it's a convenience versus risk thing. And I think every organization has to look at the trade-off between convenience and effective internal controls. The banks are now starting to have systems that allow you to, well, virtually all of our clients use an electronic payment system. But the electronic payment system that are available today allow you to still require 2 signatures. So for example, one of the systems we use is called TelPay. And with TelPay, we set up our client, and they have to have at least 2 signing authorities. So those signing authorities provide their email address. We do the bookkeeping in QuickBooks. We upload the bills that the organization wants to pay to TelPay. Those get sent out to the 2 individual directors electronically. Before the money comes out of the bank, those 2 directors have to approve the transactions. Once they approve the transactions, the money comes out of the bank. So it gives us the same internal control as check signing does, but it can be done electronically, and it can be done immediately. You don't have to drive all around the city or courier checks from city to city to get signatures. Some of the banks have even more sophisticated systems where you can put in place security limits so that each, you know, you could give your bookkeeper, you know, authority to transfer up to $500, maybe. So there are some systems out there. If you're going to use those systems, there's usually a fee for them. And the systems are getting better and better and more accessible and more convenient over time. So do your research. Find out which systems are useful and contain the internal controls that you need to be confident that you're not giving too much authority to people who could steal a bunch of money from your organization. Does that answer that?
I think it does, yes. And on that similar topic, when we have incoming cash, the question was asked specifically for a medium sized nonprofit, who would be responsible for securing that incoming cash, fundraising or finance?
It's a good question. Again, it comes down to your organization and how to see. Well, you really want to look at how you can maximize the segregation of duties in your organization. Arguably, it should be coming into someone else other than your bookkeeping and accounting department. So whether that's your receptionist or somebody in your fund development department or a lockbox at the bank that somebody in your organization will pick up, and that whoever receives the cash should document receiving it, and there should be a date, amount of cash received, and what date it was received, and then that information should be taken to the bank, and then the receipt or deposit slip should be provided to the bookkeeper to do the bookkeeping. So again, it's all about trying to make sure that you have the highest level of segregation of duties. And in smaller organizations, it's more difficult because you just don't have that many people. So just try and segregate the duties wherever you can. Yeah, so I think that.
Mm-hmm. Perfect. Okay, and we've had a few questions about credit cards and policies regarding credit cards. Do you have some suggestions on that for an organization perhaps that is just about to get started with using organizational credit cards, and also where they might go to for more information about resources for putting in good controls?
Yeah, so I'm just going to go off the top of my head here. First of all, I much prefer credit cards to debit cards. It's very difficult to put, for example, spending limits on debit cards. So we much prefer, from an internal control point of view, we much prefer organizational credit cards. Organizational credit cards are great because the credit card transactions are one of the least expensive transactions to do bookkeeping for. So it makes bookkeeping very efficient when you use a corporate credit card. But it's absolutely critical, and I'm great to hear people asking the question about what types of internal controls they should have. So first of all, you'll generally want some policies in place outlining what appropriate expenses people can use their credit cards for. Obviously, they shouldn't be using it for personal expenses, but it often happens if you don't have that policy. They go, oh, you know what? I can't find my personal card. I'll just use this card. Well, if that's accepted in the organization, it can be kind of a slippery slope. So make sure you have some policies about the appropriate uses of credit cards. Spend some time thinking about what appropriate spending levels are. How much? What should the credit limit be for each card, for each individual? And finally, make sure that there's a review process in place for everybody that has a corporate card. Somebody should be reviewing the statements other than the individual, and the individual should be required to provide copies of receipts for all transactions, always. So those are some things that you can do: spending limits, policies around what appropriate expenditures are, having a review process in place, and what was the fourth one? I can't remember. Anyway, those are some things you can do to implement internal controls around corporate credit cards.
Great. And moving on to sort of more public transparency, what financial info do you suggest be posted publicly for transparency with donors and other stakeholders?
Yeah, well, so if you're a charity, every registered charity in Canada is required to file a T3010 registered charity information return, and that information is already public. With that return, you're required to file a set of your financial statements, and I'm pretty sure the CRA policy is that if they're contacted, they will provide a set of the organization's financial statements. So your financial statements, typically your audited financial statements and your T3010 return are already public information. Certainly worth having your T3010 available on your website. And that's a pretty standard best practice, certainly for larger organizations and for many organizations, because it really does provide that kind of transparency. With not-for-profit organizations, and these are the classifications for income tax purposes from the CRA, you're either a not-for-profit organization or you're a charity. You can't be both at the same time, so you have to make sure you know which one you are. If you're a not-for-profit organization, today there isn't much regulated transparency. So the CRA doesn't require no information that you provide to the CRA, to the best of my knowledge, is available. No financial information is available to the public through the CRA. But again, recommended best practices would be to have certainly your audited statements, or some organizations, rather than providing their complete audited statements, will take components from their audited statements and include them in their annual reports and then make those available. So if your board's open to it, providing your audited statements via your website, certainly. We don't see many organizations go significantly beyond that. But that's certainly a best practice, is to provide your audited financial statements and whatever information you can in your annual report.
Okay, and you talked briefly about liabilities for board members. Could you maybe just expand on that a little bit? We had some questions, just sort of about what those liabilities look like and if there are ways to mitigate the risk beyond kind of the controls that you've covered today.
Yeah, so there was a publication done by one of the government organizations, and it's all about director liabilities and what directors are on the hook for. It's a fairly significant document. I'm going to say it's 50 to 70 pages. And if anybody's interested in taking a look at that, I'd be happy to provide them with a link to the document. So that's probably the most comprehensive overview of what the potential liabilities of directors are. Although if we gave all the directors a copy of that to read, I think it might be more difficult for us to get directors for our organizations. But just specifically for this, from the CRA's perspective, I think directors are personally liable for unremitted GST and for unremitted payroll deductions. And I think through at least employment standards in BC at least, and I suspect mostly provincially, directors can also be held personally liable for unpaid wages. And I think it's up to 6 months or something in BC. So there are some specific financial liabilities that directors are liable for. And the first thing you can do, I think, first of all, is to make sure that you do your due diligence before joining an organization. Before joining an organization, I will usually get a copy of their last audited financial statements. I'll ask for a copy of their most recent financial board report, and I'll ask for a copy of their directors and officers insurance. I generally won't join a board unless they have directors and officers insurance. I have been on a board before where the board got sued. The legal bills were over $200,000, and our directors and officers insurance covered every penny. So the directors weren't out of pocket. And it was wonderful. Had that directors and officers insurance not been in place, we individually would have been on the hook to cover the legal fees to defend ourselves. So directors and officers insurance, make sure they've got it. Do your due diligence before you join the board. Ask for information and review it prior to joining. Make sure that the organization's up to date on all of its financial filings and isn't in a cash flow crunch. Yeah, so those are some things you can do to protect yourself as a director.
Great. And finally, just before we end today's session, perhaps you could just talk a little bit about where board members can go to get more information if they're not people with a financial background, but they need to get a little bit more up to speed. I know you provided some resources in the PowerPoint. Is there other suggestions that you have for them?
Yeah, there's let's see. There's one consultant in the U.S., a guy named John Hall, who focuses specifically on internal controls, and so he's a consultant to many organizations. Does a lot of public speaking, and he's got a lot of resources on his website with respect to how to build effective internal controls and some of the things board members can do to do that. I think he consults to both the for-profit sector and the not-for-profit sector. But I think one of the tools on his website is an internal control review toolkit or something like that to sort of help you identify gaps. So that's a good start. This other document, Oh, and I'm sorry, I can't remember the name of the document, but it's actually a specifically Canadian document that talks about the director liability and basically what all directors should know about director liability. And then also many of the CPA institutes across the country, the provincial institutes, periodically put on seminars or webinars about director liability. So if you're interested in learning about that, check out your CPA provincial institute. They often have webinars and seminars on learning opportunities, and often they have learning opportunities around director liability. So there's some places to go look. And if anybody's interested, again, I can find that document on director liabilities and send people a link to that.
Wonderful. Well, thank you again, Gordon. This has been a great presentation, so full of information. On that note, before we sign off, I do want to remind everyone that we will follow up with you by email tomorrow with the webinar recording and the full slide deck. So those resources that showed up in Gordon's slide deck, you will get access to that by email, so look for that. And we'll also do our best to include the link to the checklist that Gordon mentioned in that email tomorrow as well, so that you have access to that. We'll also have a link to a short survey, so if you can take a moment to fill that out, it's really helpful for us. It helps us to plan our future content, and you'll have an opportunity there to let us know if there's other topics you'd like to see covered in a future session. So with that, I want to thank you again, Gordon. It's been a pleasure having you speak for us again. And I want to thank you. And I want to thank all the rest of you for joining us today. I hope you have a wonderful rest of your day. Thank you very much.